If you're starting on bigger deals, that's more money to raise, that's a higher barrier to entry, it's just harder. And there is this saying, and you've probably heard it a million times. I hate this saying. It is my least favorite saying in real estate. It's like, oh, if you have a good deal, the money will come.
Yeah.
No, like
Yeah.
you have to have a track record. You have to have connections. People have to trust you. I've worked with private equity firms, I can send them a deal, but the first thing they're going to do is, who are you? What have you done?
If you're a real estate agent earning $200,000 a year and you want to grow your passive income, this show is for you. Learn secrets other agents use and hear from experts in our field who will guide you on your journey to investing in assets like apartment communities so you can take your commissions and turn them into cash flow. Here's your host, Randal. Let's dive in.
Hey, welcome back to the show. It's good to have you here today. Always enjoy our conversations and introducing you to a guest that we have on. Today, it's Will Matheson of Matheson Capital. We talk about how he went from the brokerage side of the business, which is the Marcus and Millichap side of the business, into the ownership side and the investing side. His journey, how they started small, buying small multis and moving into larger deals that they're working on right now. His take on the market and where they're going in the next year. So it's a good conversation with an operator who's been in the business for a while, young guy crushing it with his brother. It's a great conversation. He knows a lot about multifamily. So jump in, enjoy the conversation. This is Will. Here we go. Hey, Will, welcome to the show, man. It's good to have you on. I'm excited to have the conversation and chat with you. Just real estate, talk shop a little bit and kind of see what you're working on these days.
Thank you for having me. Appreciate it.
For sure. So, we were talking just now about your backstory and how you got into Matheson Capital, which you're running now with your brother. Tell me, before you got into that, you were working at Marcus and Millichap. So what was the evolution, coming from school straight into working at a brokerage shop and then getting into Matheson Capital?
So it's actually, it was a pretty fun story for my brother and I. So we were working together at Marcus and Millichap out of their North Carolina office, doing primarily retail brokerage. And the way the company actually started, we weren't a buyer. We weren't buying assets. The first thing we ever did was actually a hard money loan. We had a client of ours in a big 1031 exchange, could have been $30 million or so. This was all the way back in 2015, so my memory's a little hazy at this point. But they split their exchange and they did their first closing. And for their second closing, they had $1 million equity shortfall in only 30 days before their clock expired or something like that. They couldn't get more loan proceeds from the lender, and there wasn't enough time to find, a new bank to do the purchasing on their new acquisition. So our senior broker at the time was like, find a hard money lender. We know their whole schedule of real estate owned. We could put the first lien on another property they own. So they get the million and then da 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 da.
Yeah.
And we just thought to ourselves, I remember Evan and I, we were talking on the phone one day after work, and I'm just like, or maybe it was him. Again, it's all lore at this point. We could do this. Like we could raise the $1 million they need, put a first loan on this, it's personally guaranteed. So that's what we did. That's how we started the company. We put that loan on, and I want to say August 2015, and it stayed there until December 2016, which was a great way to supplement my early career earnings, which were not significant in 2015.
That is pretty bold, though. I mean, that's pretty awesome. Like it's not a route, I guess, that you typically would go straight into $1 million. So did you raise that money, or was it partly yours and you raised, or how did that even look?
So we raised pretty much all of that money. We raised it. It was really great. I think we did something like 800 over SOFR, which SOFR at the time was nothing.
Yeah.
And we probably could have gotten 1,000 over SOFR, because while we were on the conversation, they had asked, like, so it's 1,000 over SOFR, right? And we corrected them down. Rookie mistakes from a 23-year-old.
Yeah.
So that was a good move. But no, it was a really awesome. It was bold. I'll definitely say that. The next part of the story is, Evan and I, we left for grad school. We left Marcus for grad school in April of 2017. And I remember doing a job interview in early 2018 and trying to explain this to the person interviewing me. And it resulted in them asking essentially, where did you get the balls to do something like that? And my answer was terrible, which is why nobody hires me. And my answer was essentially like, it wasn't that hard.
Yeah.
Like, where'd you get the skill set to do it? It wasn't a skill set. The guy was worth $30 million.
Yeah.
Like,
Common sense. That's what got me. Yeah,
yeah,
man.
not a good answer for a job interview.
That's funny. I interviewed my buddy who I was just telling you about his shop. They had a developer here in San Antonio, and he was hiring somebody. And I went into an interview, and I like started flipping houses. Right. So I had this machine that was going, and I was making money. And so he asked me some similar question, like, "So how do you spend your days?" Or like, "How much time do you spend on this?" And I was like, "Not much. I mean, I just have been kind of hanging out." What's my answer in this interview? It wasn't like, I built this whole system and, but, it's kind of one of those things. So good for you for answering. And the other side of that is good for you. It was an honest, approach, the 800 SOFR question, 800 or 1,000. So you can look at that either way, like you missed out, or you probably gained some, some goodwill with some people when you put it that way.
I hope so.
Yeah. So you guys got into this deal. You didn't get a job that you were interviewing with with this other guy. But what was the process when you did that loan and then you went back to grad school, right? Or you were going to a straight business school? Was it?
Yeah, so we finished the loan in December 2016. And by then, I think we had already gotten into Columbia University's Master's in Real Estate Development program. So it's a 1-year program in New York. Really great. Like, the professors are people in the real estate industry because, it's Manhattan. It's the real estate capital of America, pretty much. So met a lot of great people, learned a lot. And as Evan and I were leaving Columbia, we had done some job interviews and we're really just talking because we lived 2 floors apart. We're in the same building. I was on the 6th floor, he was on the 4th. And we're just talking and we're like, what do we want to do? And our conclusion was essentially, look, we've had a little bit of an entrepreneurial thing before, back with that loan. We actually bought a property in Los Angeles with one of our classmates in January of 2018 while we were still in the program. We sold it in March of 2018. So 2 months later, made some nice money. And we're just like, what do we want to do? And we decided we could try climbing the corporate ladder for 10, 15, 20 years to then leave and try to raise money from a bunch of funds, et cetera, et cetera. Or we could just go start buying properties right now and they'll be smaller and it'll be hard, but we don't have the golden handcuffs. I was newly married, but with no kids. My brother wasn't married. And we're just like, we don't have the golden handcuffs. Let's go for it. Let's start our business. Let's scale it up. Let's start small. And, instead of waiting 20 years to walk out and buy institutional sized deals, we'll do it in 10 or 7 or 8 or whatever.
Let me ask you, looking back on that decision, would you give that advice to yourself? Start at the small and then go to the 150 plus unit, or would you stick with the approach that you guys took? Hey everybody, Randal Cleared here with a special shout out to our friends over at Envone. If you're looking to diversify your investment portfolio, you've got to go check them out. It's envone.com. It's a crowdfunding platform with a wide range of investment opportunities, things like real estate investing and even bourbon barrel investing. So check them out. Envone hosts our crowdfund. It's actually a single family real estate investment fund that we have launched with them. And we've had an awesome experience working with Levy and his team. They're super responsive, very quick to assist us with things that we need. And they have crowdfunding down to a science. Go ahead and check out episode 154, where Levy and I discuss crowdfunding in detail and how it can help you either invest or raise capital. And check this out. As a friend of the pod, launch your crowdfund with Envone, and you're going to get an exclusive 10% discount when you head over to envone.com/ABC, or simply call Levy and his team at 475-800-8716 and mention Agents Building Cash Flow. Go crush it. Happy investing. Talk to you later.
I would 100% stick with the approach that we took. I see a lot of people reach out to me for advice somewhat frequently because I post on LinkedIn a lot. And I see a lot of people who go through coaching programs and they're saying, you got to buy bigger stuff for scale. And, that, in my opinion, 1 out of 100 people end up really doing that. Otherwise, you're getting into a deal where you've got 10 other co-GPs where you don't really own anything. And the whole co-GP system has its own issues with the SEC in some cases, depending on how it's structured. And then the alternative is you're in all these co-GPs or you're just never buying anything. it's just really tough when you're trying to compete on these $20 million deals because the brokers know everybody in the market who owns a $20 million deal.
Yep.
And they've transacted with those people, and those people have a track record, and you have no track record. So if you want to overpay, I think that's a great way to go. But like I was telling you before we started, Evan and I started small. Our first deal was 2 units. Then we did, I know all the unit counts. It was 2 units, 6 units, 6 units, 15 units, 24 units, 32, 32, 69. And then we partnered with somebody at the end of 2021 where I think we were the junior partner in this. So I don't know the number. Maybe it was 112 units. But we had just started with these really small deals. And each successive deal we did gave us more credibility with brokers. It was actually funny. We did one of our deals we bought February 2019, 15 units in Somerville, South Carolina. It's part of the Charleston MSA. We bought that property. We closed another deal in December. And come summer 22, we actually had the opportunity to buy a 32-unit deal in Somerville. The broker who sold us that property did not know we owned a 15-unit property in Somerville. He hadn't heard of that, but he knew we had bought the 24-unit property in Charlotte, and that's why he showed us the 32 units. So it just, every deal gave us more credibility with investors, with brokers, and it, we didn't spend years barking up a tree to buy a deal where, quite frankly, we couldn't have raised the equity anyway.
Yeah, great advice. The reason I bring that up is because there are a lot of coaching programs, mentorships, and that sort of thing where they're pushing a go big or go home sort of strategy. And so people come out of those things, gung ho, thinking that it's just the only way to go. And I advocate for the approach that you guys took. So yeah, thanks for being candid with that. And the other side of it is, it's one of those things where I was talking to somebody the other day and they're like, look, you're going to have a more meaningful impact on your personal income if you buy a duplex than if you are going out and being a fraction of an owner in a deal. You'll get experience that way. But yeah, anyway.
Well, no, so I'll also say this, and one of the, I alluded to this, but one of the reasons we started small is I bought that first property when I was 25, when I was in grad school, and that, we knew we couldn't raise the money for larger deals. Like if I went and tried to buy, actually, I will tell you, in 2019, just February, March 2019, we had just finished 4 closings, 2 units, 6 units, 6 units, 15 units. We went under contract on a 55-unit deal in Charlotte. We thought we had a great price, 100 a door. We needed to raise $2 million or something, and we couldn't raise the money. And we lost, I don't know, $30,000 in pursuit costs, but we didn't have the Rolodex. We didn't have the network. We tried to find partners. Someone later put the deal under contract at pretty much the same price. They used the exact same property manager we were going to use, and they sold it for, they bought it 100 a unit, and they sold for like 150 2 years later. It would have been a home run of a deal.
Yeah.
But we didn't have we couldn't raise the money. And that's another thing. Like if you're starting on bigger deals, that's more money to raise. That's a higher barrier to entry. It's just harder. And there is this saying, and you've probably heard it a million times. I hate this saying. It is my least favorite saying in real estate. It's like, oh, if you have a good deal, the money will come.
Yeah.
No, you have to have a track record. You have to have connections. People have to trust you. Yeah. I've worked with private equity firms, I can send them a deal, but the first thing they're going to do is, who are you? What have you done? Mm-hmm. I had this conversation with someone who wanted to get into the industry, and they said that line to me, and I'm like, who told you that? Yeah. Like, oh, this guy. I'm like, yeah, how old is he? Because this guy was my age. He was like 30 when we had this conversation. I said, how old? Oh, he's like in his 50s. Yeah, what did he do before he got into real estate? Oh, he was a Silicon Valley CEO. Well, yeah, if he finds a good deal, the money comes.
Yeah, the Rolodex backs it up.
Oh.
Yeah, good advice for sure. Let's talk about the transition, because when I was going through looking at the transaction history that you guys have up on MathCap, I love the name, by the way. It's like super easy to type in. So
I'll tell you why.
Yeah.
So when I was at Marcus and Millichap, I had 2 email addresses because a lot of teams at Marcus, they built their own team websites in addition to their Marcus and Millichap addresses. And there's a lot of cold calling, so you're telling people your emails over the phone. I had 2 emails. One of them was, I think, william.matheson@marcusmillichap.com, which is just a joy to transcribe to people over the phone.
Yeah.
And my other email was not significant. It was better, but it was not significantly better. It was will@greenspaninvest.com. Both of them just a mouthful to tell somebody.
Yeah.
So when we picked our website, we bought it when we were in grad school. I saw MathCap was available. I think it was like $5,000, which was a big amount to spend considering we didn't even know we were going to do a company. But like, no, no, no. We need to buy this thing because Will and Evan at mathcap.com, that's as short as it's ever going to get.
Yep. And not William Matheson at MathCap. Yeah. No, I see that, man. I saw it and immediately was like, good for you guys for taking that thing down. That's good. But let me go to the deals that you guys were buying, right? Okay. So when I look at it, it looks like you guys started again with the small, but you had these short fuses on these things. So you're buying at, a 1-year hold time and flipping these properties. So you're basically doing a commercial flip, right? Going in, forced appreciation, renoing the units and filling it up and then selling it. One, I love that model, right? That's what I've been doing on the single family side for years and years and years. And a couple of questions around it. One, are you still seeing that type of deal? Are there a lot of those, or you feel like those have been bought up and a lot of them have traded hands in the last like 5 years?
Okay, so to answer that question, they are harder to find the larger you get. I do believe one of our acquisitions that we made in 2023 will be able to successfully buy and sell within a 2-year period just because it was a distressed sale. But that short-term hold period was a key part of our initial strategy when we got started. And I'll touch on that because I think that's where you're going with question 2. And now that we've established ourselves more as a company, now that we've earned the trust of a lot of investors, we do like to use more of, say, your typical real estate strategy, 5, 7, 10-year holds, things like that. We were building to the point where we wouldn't have to do these really aggressive, quick turn value add plays.
Yeah. I mean, that's a great way to, one, build your cash reserves because you're in and out of these deals. You're returning that capital quickly to investors. Investors tend to like that. But in general, in the market, are you still seeing those, 30 to 50 unit deals that haven't had that aggressive value add program in the markets that you're in?
I'll be honest, we don't spend as much time looking for them.
Okay, that's true. Yeah.
We want to buy larger and larger properties, primarily for management reasons. They're harder to manage at smaller sizes. There are benefits to scale, even though I said, that the whole you have to get scale early is, I think, not exactly true, but there are benefits to it. I'm just saying the ability to do a smaller deal outweighs the benefit of the scale.
Yeah. That you can't do it. Yeah, can't buy it. Doesn't matter.
Not being able to buy is a significant barrier.
Yes, that is a problem. I literally just got on the phone with a broker in between the last call and this one, and they have a deal that's local and they want, 2.25 and I'm at 1.7. And the conversation has been going on and on. It's a, 16 unit deal here locally. And, I've just been in that price point with those types of deals nonstop. That's an aside. It doesn't really, to the point of not being able to buy. I'm unable to buy because the profile of the return just doesn't seem to make sense. The pricing still hasn't made sense to me. But anyway, I wanted to talk about some of the deals. So when I was reading through one of the deals that you guys did, it sounded like you said we implemented because they're smaller deals, like management is a challenge, but you guys implemented some sort of like offsite management process. So is that accurate or did I misunderstand what I read?
Depends which property you were talking about.
I didn't know if you guys had found a way to, because when I first started into this, everyone's telling you, you go big because of third-party management, on-site staff, and it's easier to manage those things. And so I started looking at, on the smaller deals, if you can solve the problem of management by having it somehow automated, almost like storage facilities are automated or have become more and more automated, that takes out a huge line item on your budget. And so then you could be more aggressive on your pricing and you have a huge value add that you could add because of the management component. That's why, long story, I'm asking if you guys found some way to do that or if I misunderstood that.
I believe on Timberstone, that was 69 units. I think it was staffed at one point prior to there was like pseudo staffing when we bought it, and we were able to take that completely offsite. I will say for the smaller properties, I kind of view it this way. You tend to think that, and this is actually another benefit of starting small, the bigger things get, the more efficient the market for it tends to become. And in property management, I don't mean to slight anybody, but if you just had to use generalities, you would say the biggest property managers, the people who are managing the biggest buildings, are probably the best property managers. So as you move lower and lower in the unit count, the pricing is going to become less efficient because, every now and then, like we bought a property off the MLS. You never see that. Like buying an apartment complex off the MLS can be an absolute steal, but the pricing becomes less efficient because the brokers don't do as much. There aren't as many comps to base off of, and the management is oftentimes less efficient. So if you can find a good property manager, they can make a world of difference. And we've worked with quite a few, and we think we've found some good property managers in the smaller space. But the inefficiency of that portion of the market, you can really benefit from.
Yeah, that's kind of what I was thinking in general. Like, again, I'm a broker, and so we were planning on buying and managing some of this stuff in-house and learning that process and kind of seeing what that looks like. But I also don't want to necessarily do that long term. That is not a business I'm trying to stand up and do. Are you guys vertically integrated on some of the stuff you guys are buying? Are you guys?
So we have a partner. I was going to say we have a partner who manages our assets for us, and he invests in the deals. So we're not traditionally vertically integrated, but we do have buy-in from our management partner.
Yeah, that's helpful. One, I think it gives you guys insight into kind of the operations on what they're working on, and or more so maybe, but they have skin in the game, so to say, if he's investing.
So we did not do this, but I think there is some validity to the idea of if you're getting started and you're doing this full time, or even if you're doing it part time, but if you're getting started buying smaller apartment complexes, I think there's a lot of validity to owner managing them. One, if you're doing it full time, I'll just be very blunt. Like if you're charging a 2% acquisition fee on $1 million deal, it's $20,000. That's not going to get you through the entire year. Asset management fees on a property that size are not worth anything. Mm-hmm. So managing your own properties, it can be an additional income stream, but it can also teach you so much. You will learn so much from managing properties.
Yeah. Yeah. What are some of the key, again, you guys did that, right? Were you guys self-managing some of your smaller ones?
No, but that's actually something we've never done. That's why I said we did not do it. Part of me is like, maybe we should have. We've since found good management partners and we're buying larger properties. So,
yeah. All right. So then I guess let's talk about that shift. So you guys are now looking at and buying. One, the market has changed since you guys started. And again, I looked at, what you guys are trying to deploy on a per deal basis, look like 100 plus units plus $15 million plus purchase price, something along those lines. Is that accurate?
Yes, our most recent acquisition was $38 million, 248 units in Savannah, Georgia.
Okay. And so moving again from the smaller into the bigger unit sizes, how have you guys found capital raising on those deals in the current market?
So that's it's a bit of a double-edged sword there. And I'll actually, just to really give a long answer, I'm going to circle back to our initial strategy on this. So high level to answer your question, capital raising is difficult. It's more difficult than it was in 2021. The market was hot. People were throwing money out there. But we are also raising more money year over year, and that largely coincides with our growth. This year is going to be our largest equity year ever. 2023 was bigger than 22, 22 was bigger than 21, et cetera. So we've been growing despite the market contracting. So one of the reasons that, again, we started with smaller properties, I mentioned it's so we had less equity to raise. And we did shorter term hold periods because we wanted to build a track record. But that has this added benefit where, to use an example, if you raised $1 million and put it into a property and you sat on that property for 10 years and you delivered all of these dividends, that's great. Your investors are probably happy, but you've raised $1 million and you've bought one property. We are very transparent with our investors when we bought these deals. We told them that they were going to be short-term holds. They understood our incentives. We had performance bonuses, and we don't do 1031 exchanges, which comes into play here. But when we would buy a deal, if we'd raise $1 million and we'd return $2 million to investors, they'd get that money back and they'd come and do our next acquisition with us. And they'd be like, oh, I want to invest. I'm so happy with the last one. So theoretically, I could have raised the same money from the same investor 3 times. And it counts as raising money 3 different times. So like on our track record, it'll show like I raised, instead of saying I raised $1 million, I raised three. It was the same million 3 times.
Yeah.
And I got 3 acquisition fees and I got 3 promotes. And again, we tell all of our investors, like, this is part of our strategy. It is to grow. We are performance based, et cetera, et cetera. So again, circling back, it's been harder to raise money, but we are raising more than ever. And because we use fixed rate debt, fortunately, we sold pretty much everything in our portfolio at the end of 21, beginning of 22.
Yeah.
We have a lot of happy investors. We're in a pretty good spot.
Yeah. Look pretty good. Pretty smart doing that. I guess I want to talk then about like return profiles, the types of terms that you guys do on some of these deals. I don't know if you can talk about that. I don't know if you have anything open that you're actually raising for or not.
Nothing we're trying to syndicate right now. Obviously, you can see on our website, our average LP IRR has been 40%, which, being candid, if you know how IRR works, that's bolstered by the fact that we've had shorter term holds. We've been selling a lot of properties under 2 years. But today, we're typically trying to offer our investors north of 18% IRRs. That's what we're typically trying to offer. Now we focus more on, say, 3, 5, 7-year holds in some perspectives, because we have built that trust, we've built that track record, and we want to establish a little bit more of a business. The way we think about it is owning a property for 3, 5, 7 years. That's more of a business, whereas doing these really short-term turnaround plays on properties, we view it as more of a service.
Yeah.
It's not as consistent, it's not as sustainable. And to a point you made earlier, it's been 10 plus years of a lot of apartment investing. It's hard to find those properties that are fresh and you can really get in and get out of.
Yeah, that's what I was wondering. A buddy of mine did one here in San Antonio, and I saw what he did. I mean, it's great when you can find those and do those. But okay, so when you guys are going through and raising the money, the returns, again, how are you structuring? I just like to talk about it just because then it gives anyone looking at alternative investing an idea of how these deals are structured. So on your early deals, you said that you guys had some sort of waterfall with bonuses built in for you guys if you hit certain hurdles, right? I'm assuming IRR or some kind of target return, right? Yes. How has that changed on these other deals? And are you structuring typical 70-30, 80-20? Like, how do you guys structure your setup on your syndications?
So when we got started, in the good years, it was 7-8% preferred returns to investors with maybe a 30% promote on top of that. And maybe we'd layer in other things where it's like, if we exceed 20%, we'll get X. If we exceed 25%, we'll get Y, because nobody complains when you deliver more than a 25% return in a short amount of time. Everyone's happy with that. So that was kind of how we started. We have, just generally speaking, the equity environment has changed because so many people are wary of investing in 2023 and 2024. Preferred returns have been rising and the promote splits on top of those have been falling because, the equity that is investing has a lot more say. People want to do a lot of preferred equity or mezz debt instead of traditional equity. So when they do come out, they might say, we want a 10% pref, or we want an 11% pref with a 20% promote to you on top of that or something. So the terms are definitely more investor favorable right now, which, if you want to look at it that way, it makes it a good time to invest as an LP.
Yeah. Yeah, that makes sense. Good feedback. So I also want to talk, I guess, about your investors that have come along on the ride. And again, early days, they're looking at a short, quick hit. Their money's in and out. It's back. They can use it. They can reinvest or not, but they have access to that capital. And so how has the conversation shifted with you guys and your investors saying, look, guys, we want long-term. We want fixed rate debt. We're not trying to just turn and pop these things. Do you have any, ambitions to change it to where it's just either a fund structure where you're just going out and you have that capital at play and some kind of like evergreen fund where you guys can deploy that capital as needed and just turn it internally so that you guys can go out and churn properties or hold them long term? It's like 5 questions in there, so maybe we can back up.
No, I mean, the simple answer is that fund is really just the ultimate form of vertical integration. If you have a discretionary fund, investment fund, that means that you can go out there and buy any investment you think is a good investment. It helps you buy investments, to be honest, because you can tell brokers and owners, I have total discretion over this. So, I think the end game dream of anybody in this industry is to have a discretionary fund where as soon as they see a property, they just notify the investors, hey, here's the capital call, found a great opportunity, and the money comes in. Being very blunt, I know that we are not close to that. So don't spend a lot of time thinking about it.
Yeah.
For the time being, we're just going to continue to focus on each individual asset. And we're one asset at a time type of group.
Yeah. Yeah. Nice. Okay. Good feedback. Your investors, though, is the conversation at all shifting again with them? They are happy with the longer term holds and more consistent. There's a group that, when you have, I guess, investors who aren't IRR driven, right? It changes your ability to go after certain types of assets. And so I guess that's the question. Are your investors mostly IRR driven, or are they looking for like a coupon type of deal where they can come in and park their capital, know that it's going to be safe and secure for years to come?
So, in the end, I think even if investors are looking for that coupon, that still is an IRR equation. It's just a different risk profile.
Sure. Yeah.
The quick in and outs, even when we were doing the shorter deals, we were modeling 3 years, but we told them we're trying to sell it in a year and a day for capital gains reasons. We've retained a really strong amount of our investors as we've grown. And they also, it's one of those things where, yes, it might not be the short get in, get out, but that's like complaining about hitting a double because you wanted to hit a home run.
Yeah.
Good investments are good investments, and they've largely come along for the ride.
Yeah, that makes sense. What are you guys seeing for the next 6 months? What are you guys trying to do or a year?
Our general position has been now's a good time to buy. Prices are down 20 to 33% from the peak based on who you ask. For the longest time, a lot of equity was on the sideline. You are seeing that change with KKR and Blackstone making some acquisitions. And I think you're going to see a little bit of a follow the leader mentality in terms of, now the big guys are back in the game, so we're not going to get fired if we get back in the game because we're following Blackstone. So I think prices have dropped. Debt is hard to come by. A lot of equity has been or is just now coming. It's been on the sidelines. It's coming back in. So my outlook is 3 years, 5 years from now, rates will be lower. Liquidity will be higher, demand will be higher. So now's a good time to buy. And we're actively looking to buy.
Yeah. Well, I think that's probably a good place, man, to leave it. It's having the conversation and kind of seeing where you guys have gone, the progression. I'm in that same belief. I think my thoughts right now are if I could buy something right now, rates drop, it's immediate increase in value just from now until when that happens. And then over the next 5 years, I think it's a good time. So are you guys focusing still just in the Carolinas? Is that the buy box right now?
We are Southeast focused. We own one property in Georgia.
Okay.
We're currently, we look in Alabama, Tennessee, Virginia as well. But, we're really opportunity driven. We do think the Carolinas just have phenomenal demographic growth factors. Good job, good political environments, good economic environments. So that continues to be our primary focus.
Yeah. Awesome. Well, it's been awesome catching up with you. I appreciate you jumping on and just telling me more about your business, what you're working on, and sharing your knowledge with us. If anyone wants to reach out to Will directly, I'm going to put contact info in the show notes for reaching out to you on your website, and feel free to reach out, talk to him about any opportunities they may have coming up. So again, Will, thanks for jumping on.
Thank you for having me.
Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.